Now, normally when I speak, I tend to extemporize and ad lib because what I'm going to say today I think is important, and we put a lot of thought behind our approach to the crypto world as a whole. I'm going to stick, as they say, to the script. And Angie did point out that at last year's FinTech Week, I talked about some emerging regulatory views on technology in financial services, and especially in relation to blockchain-based crypto assets, and what a difference a year makes. In 2018, the crypto world was actually seen to be of marginal importance to the global financial system. And I say that in part because one of the things I do is participate in the Financial Stability Board, which is basically the G20's financial regulatory arm. And last year it concluded that although blockchain, and in my script this is inverted commas, but blockchain in inverted commas currencies such as Bitcoin were seen to be problematic from an investor protection angle, they were not seen to, as yet, pose any financial stability risks. But then came Facebook's Libra, and the international regulatory community had to get its act together, and had to get its act together very, very rapidly. So today, what I want to do is run through some of what's happened over the past 12 months from a regulatory perspective, and as I did last year, I'll outline some very important announcements we will be making later today about the regulation of crypto assets in Hong Kong. First, there's absolutely no doubt that we've had to contend with a growing list of issues as regulators raised by technology and financial services. Those at a high level include how to apply existing regulations in the context of increased automation, and also the adoption of AI and machine learning, or whether we need to introduce entirely new rule sets to manage activities based on new technology. And many regulators are also concerned about financial services that are outsourced to a small number of big tech companies. And in fact, only last month, the SFC issued a statement on how we expect records, financial records, regulatory records, to be accessible when firms use cloud computing. And on top of this, data privacy issues are looming ever larger, as are fundamental questions about how to regulate conduct in financial services when machines, not humans, make decisions. Now, we recognize that we must be open to the benefits of innovation. But our bottom line is that we need to stay vigilant about the attendant risks around new technology. The basic approach globally amongst all the regulators I interact with is technology neutral in terms of regulation, same business, same risks, same rules. But the sector which has seen more regulatory activity than most is, as I've said, that involving crypto assets. Now these go, you'll all be familiar with this, these go by many different names, including cryptocurrencies, although the official sector, or the so-called official sector, central banks, finance ministries, regulators like us, have studiously avoided that term because it implies that crypto coins, digital tokens, ICOs, and the like are equivalent to money, which they are not. And at the SFC, we've been using the term virtual assets as a relatively neutral label. And there's no doubt that these virtual assets have been moving further into the conventional financial system, with more falling within the existing scope of securities regulation. You know, one example is Bitcoin futures, which are now offered by traditional established exchanges in the US. And in other areas, firms that traditionally offer safe custody of familiar financial assets, stocks, bonds, and derivatives, etc., are now looking to provide similar services for virtual assets. Insurers are more open to providing coverage, and demand from virtual asset businesses has prompted the Big Four accounting firms to expand into the area. Separately, some large, well-established financial institutions are seeking to develop their own crypto tokens on private blockchains to enable cheap, instantaneous, cross-border payments for their institutional clients. And that brings me to the explosion of interest in so-called stable coins, and Libra in particular. These typically claim to have a mechanism to stabilize their value by backing a virtual token or coin with fiat currencies, commodities, or a basket of other crypto assets. And that's not to say that they are 100% stable. I think the term stable coins can be a bit of a misnomer depending on the context. But certainly in contrast to a crypto asset such as Bitcoin, which has no intrinsic value whatsoever and is as a result extremely volatile, their relative stability or claim of stability is a key attribute. As is the pitch that they might accelerate financial inclusion in unbanked markets and make cross-border payments far less expensive. But you can't fail to have noticed from media coverage that stablecoin proposals have led to serious regulatory concerns among a range of central bankers, financial regulators, but also politicians. They are especially concerned about proposals which are capable of being adopted extremely rapidly on a global scale. And you will have also read that Facebook's Libra project has faced headwinds since it was announced not long ago. It was only in June of this year, with founder firms such as MasterCard and PayPal leaving in recent weeks. But regardless of its future prospects, the Libra project has at least galvanized regulators across the world to take seriously the opportunities and the risks inherent in virtual assets. And that is a complete change from the relatively relaxed attitude only last year. We now recognize that any convincing official sector response will need, for the first time, pretty much for the first time ever, to coordinate properly across two really important dimensions. The first involves the need for the full range of domestic data privacy, financial stability, competition, anti-money laundering, and consumer and investor protection authorities to work together on an unprecedented scale. And that's because stablecoin initiatives, especially those proposed by big tech, involve risks in all of those areas. And to add to the challenge for regulators, the second dimension is that all those authorities also must coordinate globally to tackle a real risk of regulatory arbitrage. The concern is that if, say, a retail stablecoin were approved in one jurisdiction, say as a payment system, it could easily go global very quickly, particularly if it rides on the back of the huge user base of a big tech platform. There are even fears that have been expressed that a global stablecoin could result in countries, especially in developing markets, losing control over their own currencies and monetary policy. And in fact, Libra and similar ideas have raised such fundamental issues about the digitalization and the potential privatization of money that they have already inspired the beginning of a new type of global multilateral approach among central banks, other regulators, governments, in which the SFC, our organization in Hong Kong, is very closely involved. So watch this space, because there'll be much more to come over the next few months on that topic. However, today, what I really want to do is to concentrate on what the SFC has been doing in Hong Kong in response to the use of new technologies. Now, over at the HKMA, I know Eddie was here earlier on, the big story has been, among others, virtual banks. For the SFC, the key focus of our work has been whether to regulate platforms commonly known as crypto exchanges, through which the public can trade a whole range of virtual assets. Now, we saw this as a priority because that type of platform has proliferated in Hong Kong and up to now has largely escaped any form of regulation. Now, why is that the case? It's because most virtual assets fall outside the legal definition of securities or the legal definition of futures contracts. So if a platform only offers these non-securities types of crypto assets for trading, the operations of the platform itself escapes the prospect of being subject to any investor protection regulation. But notwithstanding that, we haven't been inactive in the area. For instance, we've intervened in several cases, mainly involving initial coin offerings, ICOs, where we provided regulatory guidance, issued warnings, or in some cases took formal regulatory action. But our policy work has mainly concentrated on businesses where the virtual asset world most closely interacts with financial services and the wider public. And they are, first, investment funds with exposure to virtual assets. And secondly, as I've mentioned, those platforms across which the public can trade virtual assets. Now, as to funds, we started with announcements made at last year's FinTech Week, shortly followed by detailed conduct standards for brokers which distribute virtual asset funds, as well as the standards expected of fund managers themselves. And these measures meant that, in sum, that investor interests are now appropriately protected, either at the fund management level or at the distribution level, or both. But that left the crucial area of virtual asset platforms to be looked at. Crucial because it is through those platforms where the public mainly gets access to virtual assets, a whole range. And crucial because Hong Kong is a home to a large number of those platforms. So later today, what we'll be doing is publishing a new regulatory framework which will enable virtual asset trading platforms to be regulated by the SFC. Now, that is a major development, and it does build on a potential way forward I outlined at the same time last year at FinTechWeek. Now, at that time, and I risked repeating myself, I said virtually the same thing last year, but it's worth making this clear. We were very alive to the special idiosyncratic risks that are posed by virtual asset trading platforms. The safe custody of a user's crypto assets and also cyber security are obvious major concerns. There have been many instances of platforms being hacked, with investors suffering substantial losses globally. Trading rules across platforms may not be transparent and fair, and crypto markets, as any market is, are vulnerable to manipulation. Members of the public usually trade through these platforms directly over the internet, rather than through SFC-regulated brokers or advisors who would otherwise provide a valuable layer of protection. And the anonymity and other technical features of blockchain-based crypto assets are an issue from an anti-money laundering perspective. So, bearing all of these risks in mind, and as a regulator, we are paid to worry, and then to satisfy ourselves that the way forward requires us to worry a lot less. We met with a large number of crypto platform operators to see whether we could design a credible regulatory response and whether some platforms were in fact capable of operating in a regulated environment. After an in-depth examination of the unique technical and operational features of these platforms, we finally concluded that some could be regulated by us. So what we will announce today is a detailed scheme for the regulation of crypto platforms. It draws heavily on the standards which we expect of conventional securities brokers and automated trading systems, but it also adapts those standards to deal specifically with technology on which the industry is based. Our new framework covers all of the key investor protection concerns, including safe custody, know your client requirements, anti-money laundering, and market manipulation. And it also zeroes in on many of the new concepts we are getting used to, such as hot and cold wallets, forks, airdrops, and the like. We will also set out the criteria for platforms to decide on the inclusion of a new virtual asset for trading. And we'll make sure that platform operators provide services to professional investors, and then only to those who could demonstrate that they already have sufficient knowledge of investing in this area. And finally, all licensed platforms must have insurance covering the risk of virtual assets being lost or stolen. Now, a very, very important point. I've mentioned that the SFC only has power to regulate a platform that trades virtual assets or tokens which are legally securities or legally futures contracts. Bitcoin and other more familiar crypto assets are not securities. And nothing in our new framework actually alters that position. It can only apply to those platforms which decide to include at least one security crypto asset or token for trading. But once that happens, our new rules will apply to all platform operations, even if the vast majority of other virtual assets on the platform aren't securities. So essentially, it's a framework allowing a platform operator to opt in to regulation. The benefit is that it would then be able to say to all its clients and users that it is a supervised business. Once licenses are granted to those platforms which choose to opt in, investors will then be able to distinguish easily between properly regulated platforms and all the rest. The upshot is that the SFC will from today invite licensing applications from platform operators who are committed to and are capable of complying with our licensing criteria and continuing conduct requirements. Now, although we've come up with a comprehensive regime for those platforms that choose to be regulated, the fact is that we are doing this under existing legislation which was not designed with the crypto world in mind. And that leaves us with inevitable gaps and limitations. First, most virtual assets traded on an SFC licensed platform will not be subject to the same kind of regulation which applies to traditional offerings and trading of securities and investment funds. So, for example, there aren't any disclosure requirements for an offer of virtual assets which are not legally securities. And they will account for the majority, they will still account for a majority of the products traded on licensed platforms. Further, the SFC's usual authority to take legal action against market participants for misconduct, legal action, will not apply to licensed virtual trading asset platforms, and that's because those platforms are not recognized from a legal perspective, not recognized stock exchanges or futures markets. And we also recognize, and this is really important, that Hong Kong hosts, as I've mentioned, dozens of virtual asset trading platforms which, while posing serious investor protection concerns, may not decide to seek an SFC license under the new framework. As I've said, they can do this simply by ensuring that no virtual asset traded on their platforms is a security. They may well take the view that the SFC's regulatory expectations are too difficult or too costly, and that they would much rather continue as an entirely unregulated business. And we recognize that this remains the most significant limitation and explains why the maximum we can do at the moment is to offer an opt-in solution. Now, it was, of course, open to us to delay any regulatory response altogether, notwithstanding the growth of virtual asset trading platforms in Hong Kong. We could have waited until any new legislation is designed and implemented to cover the entire virtual asset sector. But we decided that it would be wrong to bury our heads in the sand just because we couldn't right now provide a comprehensive answer. Legislation is usually a fairly long or very long process. And it was clearly in the public interest to act now, allowing investors who choose to participate in crypto investing to choose only to invest through those crypto platforms or exchanges which agree to be regulated and supervised. But I should emphasize that this can only be an interim measure. The rapid evolution of the virtual asset sector cries out for new, tailor-made, comprehensive legislation which enables innovation, benefiting investors and economies, but also enables an environment where new risks are addressed properly. And as I mentioned at the beginning, I think that the game-changing proposals around stablecoins, in particular global stablecoins, are likely to be a catalyst for accelerated thinking about an overarching, globally consistent set of regulatory expectations. One further thing. We have been concerned for some time about platforms which offer virtual assets futures contracts to the public, and particularly contracts which are very, very highly leveraged. They are volatile, they're extremely risky, and valuation is extremely difficult. And platforms offering those contracts have also been criticized for changing their trading rules during the life of a futures contract, including halting trades or rolling back transactions. So we will be issuing a second statement today which alerts investors to those risks And it also makes clear that those who offer virtual asset futures for trading may well be conducting an illegal activity, either under the SFO, the Securities Futures Ordinance, or the Gambling Ordinance. So, just to conclude, and I'm way over time, because the screen in front of me tells me I'm 10 minutes over time. But I do want to conclude. Firstly, I want to emphasize once again that our rules are meant to be principles-based and technologically neutral. And the challenge is how to apply consistent principles of investor protection and provide useful, detailed guidance on the use of innovative technology in an incredibly fast-moving environment. And we and other regulators around the globe want fintech to flourish in a way that promotes a very high level of confidence in all of those who participate. Now, the jury is still out on whether some virtual assets, especially those that have no intrinsic value, have a useful social function, or can be considered to be the equivalent of conventional financial assets. But it's clear that if we do regulate operators in the virtual asset space, we should hold them to the same standards as the rest of the financial system. And that's a principle which I think is shared by all global regulators I've spoken to on this topic. So I will conclude now. We hope in the SFC that the measures we're going to announce later today, it's quite a long announcement incidentally, so you need to take at least, I'd have thought, half an hour to read through it, because it does contain detailed model terms and conditions for a platform. Anyway, I hope that the measures that we will announce will encourage the responsible development of new technologies, influence the international debate, and I'm sure they will, and also provide investors with more choices and better outcomes. So with that, thank you and enjoy the rest of FinTech Week.